Hi there, Mark Allen Wilson here. Welcome to the video cast. This is episode 2 where we're going to discuss economics. In video 1 was cut a little bit short. I had some troubles with the editing. I hope I can do a little bit better job this time around. So there were some topics that I was not able to discuss. However, we'll catch up on those on future videos. Today, big economic news. Mario Draghi, head of the ECB, the European Bank, has decided to cut loan rates, cut interest rates. Now, along with that, also is going to have 80 billion euros worth of stimulus to go along with it. We've seen nothing but stimulus and cut interest rates since 2008, and it hasn't really gotten us very far. This is not a very strong economic recovery that started in 2008 after the housing crisis. So, what we have seen in the past, since 2008, we have seen central banks cut interest rates 637 times and purchase a staggering $12.3 trillion worth of assets. If not for this stimulus, we would have a full-blown recession. Now, of course, we're going to have a recession anyways. This is just delayed the day of reckoning. So, ECB cutting again, and also more quantitative easing. Of course, that's the American term. I don't know what they call it in Europe, but it doesn't really matter what you call it. It is more government stimulus. Now, of course, we're doing the same thing in Canada. We do have Justin Trudeau state that he wants to spend $40 billion, put us $40 billion further in debt to try to move the economy along. Well, we increased our monetary base about 4 times since 2008. So if that hasn't gotten our economy moving along, I don't know what this extra $40 billion is going to do. Now, Canada kept their interest rates alone. Just the other day it was announced. Of course, the option is to cut lower. They're at 0.5%. So half of a percentage point you can borrow money for, or certainly the banks can. They'll loan it to you for a little bit more of a premium than that. However, it's not really doing enough. Now, we do have some countries, like Japan recently, is now in negative interest. And if you want to think of what that really means, if you can think about economics and how it would affect you in your own household. If somebody came to me and said, Mark, I want to borrow $100 from you, and in a year from now, I'll give you $99.50 back. I'm going to say no deal to that. Well, first of all, I'm going to be without my money for a year, and second, I'm going to have less at the end of the year than what I started with. Well, that's exactly what Japan is doing. And Canada might well be on its way to doing that. Who knows, the US could be well on its way to doing that. The US is the last country to increase their loan rate. They did that in December. And what was the result? The result was a 20% drop in the stock market. And it was a big acceleration in the value of gold in dollar terms. Now, we did get a jobs report from the US. It was fairly positive. It was over 200,000 jobs created last month. And this is the number that the US normally looks at when they're deciding whether or not they want to increase key interest rates, keep them the same or lower them. Now, those job numbers look pretty good on the level, but when you dig behind them and you see that most of them are minimum wage jobs, part-time jobs, it's a lot less impressive of a number. So if you have someone who used to make $50,000 a year in a good factory job back in 2008, all of a sudden they lose that job and it gets replaced with 3 jobs that all pay $10,000 a year. That person is not better off because their income is down $20,000. But as far as statistics go, it shows that the US lost 1 job but created 3. So it's a positive number. So we always have to look behind these numbers to know what they actually mean. and they don't mean very good things right now. Now, because it was a positive number, and it was the number that the American Central Bank was looking for, there is a strong chance that in a week or two's time, they may raise interest rates again. But the last time they did this, the stock market dropped 20%. It has reclaimed about 5% of those losses, but this is a terrible start to the year economically for both Canada and the US. So, if they decide to raise interest rates again, it would make sense that last time they did it, the stock market dropped. If we see another 20% drop in the stock market because the US raises interest rates 0.25%, that's going to put us in full-blown economic recession. And of course, that's not what anybody wants. Certainly, President Obama doesn't want us to have a big economic downturn. Well, what's going to happen if they do raise rates? We're going to see that downturn. And normally what happens with the price of gold when we raise interest rates is that the value of gold will go down. Because if you can buy a government bond that pays a coupon or pays an interest, or you can hold gold that has no yield at all, one would hold the government bond and actually have more value at the end of the year than what you started with. However, when the stock market goes down, based on bond prices going up, and based on the interest rate going up, everyone gets scared. And where do they go for the safe haven? They go to gold. So this time around, if the Federal Reserve decides to raise interest rates, we're not going to see a decrease in the price of gold. In fact, we're going to see an increase in the price of gold. And we're going to see a big decrease in the value of stocks. So if you're invested in stocks, beware. Now, the truth of the matter is a lot of stocks are overpriced anyways, and they probably should come down.